Thousands of dollars once promised are now disappearing. The Internal Revenue Service sometimes wants your electric vehicle tax credit back. It is a big headache for many folks. People bought new electric cars thinking they would save $7,500. But the rules changed fast. The Inflation Reduction Act came into law in August 2022. That federal law completely rewrote how these credits work for new clean vehicles. Before this act, rules were simpler, with less focus on domestic production. Many vehicles qualified just for being electric. Now things are much more complex, involving multiple strict criteria. One big reason for the IRS clawing back money is vehicle manufacturing location. Your new electric car must be assembled in North America. This means the car itself needs to be put together here in the United States, Canada, or Mexico. For example, in 2023, many popular cars like the Hyundai Ioniq 5 and the Kia EV6 no longer qualified for the full credit. Even popular models like certain trims of the Tesla Model 3 sometimes do not qualify depending on the specific battery pack and final assembly point. This single requirement immediately cut a huge list of previously eligible vehicles. Buyers often did not know this critical detail when they made their purchase, relying on outdated lists or incomplete dealer information. This led to serious frustration and financial surprises for hundreds of thousands of buyers across the country. Another huge sticking point is the battery components and critical minerals sourcing. This is split into two distinct parts of the $7,500 credit. One part of $3,750 depends on battery components. The other part of $3,750 depends on critical minerals. For vehicles placed in service in 2023, for example, at least 50% of battery components by value needed to be manufactured or assembled in North America. This threshold increases to 60% in 2024. It will hit 70% in 2025 and 80% in 2026, ultimately reaching 100% by 2029. For the critical minerals, at least 40% of their value had to be extracted or processed in the United States or a country with a free trade agreement with the US in 2023. This percentage also increases significantly to 50% in 2024, 60% in 2025, 70% in 2027. These are massive and challenging shifts for automakers globally. Many manufacturers struggle to reconfigure their complex global supply chains within these tight deadlines. And billions of dollars are being invested, but it takes years to build new facilities and secure new mineral sources. Then there are strict income limits. This catches many potential beneficiaries off guard. For a married couple filing jointly, your modified adjusted gross income cannot be more than $300,000 in the year the vehicle is placed in service. If you are a single filer or married filing separately, the limit is $150,000. Head of household filers have a $225,000 limit. If your income goes even $1 over these caps, you receive zero credit. Many individuals or families might not realize they are above this income threshold. They might claim the credit only to have the IRS disallow it later during an audit or review. This means paying back the full $7,500 potentially with additional penalties and interest. It is a financially costly mistake for many households. Vehicle price is another major restriction that disqualifies many models. The manufacturer's suggested retail price, or MSRP, cannot exceed certain amounts. For cars, including sedans, wagons, and smaller electric vehicles, the cap is $55,000. For vans, sport utility vehicles, and pickup trucks, the cap is $80,000. This rules out many luxury electric vehicles instantly. A Tesla Model S or a Lucid Air will almost certainly be well over these limits. Even some higher trim Ford F-150 Lightnings might exceed the truck limit. What complicates this is how the IRS defines an SUV versus a car. For tax purposes, sometimes a crossover that looks like an SUV might be classified as a car for the lower $55,000 MSRP cap. This has created massive confusion for buyers and even dealers, leading to incorrect assumptions. Checking the exact classification on the IRS website or official government sources before buying is critical. Otherwise, you could be buying a truck that is taxed as a car. The seller also has specific requirements that impact the buyer's eligibility. The dealer selling the new clean vehicle must be registered with the IRS. They also need to provide a clean vehicle seller report to the buyer and submit one electronically to the IRS at the time of sale. This report includes information like the vehicle identification number, battery capacity, and maximum MSRP. If the dealer does not do this paperwork correctly or is not properly registered, the buyer cannot claim the credit. This is often not the buyer's fault, but the buyer still loses the $7,500 credit. Many smaller dealerships might not be fully up to speed on these strict new regulations, adding another layer of complexity and financial risk for the consumer. Dealers began submitting these reports in January 2024, making the process a bit more streamlined for future purchases, but retrospective issues remain. Even the year of purchase matters significantly. For example, vehicles purchased before August 16, 2022 had different rules and did not have the North American assembly requirement, but vehicles placed in service after that date immediately fell under the new rules for assembly. Battery component and critical mineral rules then came into effect in January 2023 and January 2024, respectively. So a car purchased in December 2020 might have different eligibility than one purchased in January 2023 or even July 2024. It is a constantly shifting landscape. The IRS updates its list of eligible vehicles often, sometimes monthly, or even more frequently. Keeping up with it requires constant vigilance. Many people assume what was true last month for a particular model is still true this month. It often is not due to changes in battery sourcing or manufacturing. There is also a separate credit for used electric vehicles. That is a maximum $4,000 credit, but it has its own strict rules too. The used vehicle must be purchased from a dealer, not a private party sale. The sale price cannot exceed $25,000. The vehicle must be at least 2 model years older than the calendar year it is purchased. So in 2024, it must be a 2022 model or older. And buyer income limits apply here too. Single filers are capped at $75,000 modified adjusted gross income. Married filing jointly is $150,000. Head of household filers have a $112,500 limit. So these used EV credits are also not for everyone. The entire system is designed to incentivize domestic manufacturing and resilient supply chains for clean energy technology. The goal is to reduce reliance on foreign adversarial nations for critical components, but it has inadvertently created a confusing and frustrating maze for consumers trying to do their part for the environment and save some money. Many people find out they are ineligible only when they prepare their taxes months after the purchase. They might have taken out a loan or made other financial plans based on getting that $7,500 back. When the IRS denies the credit, it can cause significant financial strain. It is a substantial amount of money for most households, often representing 10 to 15% of the vehicle's cost. The government wants to encourage electric vehicle adoption, but these overly complex rules can actually deter some buyers. They fear falling into a trap of unexpected debt, and they fear owing the IRS money after believing they were eligible. The number of eligible vehicles has been drastically reduced over the past 2 years. In 2023, for example, the list of qualifying new EVs was much shorter than in 2022. Many popular models completely vanished from the list. This includes some versions of the Nissan Leaf and most Audi electric vehicles. And BMW EVs, even some Volkswagen models and certain Ford Mustang Mach-E trims lost eligibility. The constant changes in critical mineral and battery component sourcing mean a vehicle might qualify one quarter, but not the next. Automakers are trying hard to meet the requirements by investing tens of billions of dollars in new factories and localized supply chains in North America. For instance, companies are building battery plants in states like Georgia, Michigan, and Tennessee, with projected investments reaching over $100 billion by 2030. But this takes years to come online and scale production. Ultimately, the IRS wants your tax credit back if you did not meet all the precise requirements of the Inflation Reduction Act. It is not about taking money unfairly from citizens. It is about applying the law as written by Congress. But the law is very specific and has many moving parts that change annually, or even semi-annually. Taxpayers need to double-check every single detail before committing to an electric vehicle purchase if they plan to rely on that credit. Check the vehicle identification number on the official IRS website tool. Confirm the manufacturer's suggested retail price. Ensure your adjusted gross income is within the established limits. Confirm the dealer is registered and provides the necessary seller report. And understand exactly when the battery and assembly rules apply to your specific purchase date and model year. It is an overwhelming amount of information to keep track of for the average consumer, and failing to do so can result in a big bill from the government, later on potentially adding penalties. So that promised $7,500 can quickly become a debt owed to the government. It is a harsh reality for many enthusiastic new EV owners, and it is precisely why the IRS is sending those notices. Many people are finding themselves in this exact difficult situation right now.